If you're a high salary earner, then your contributions to all of your retirement schemes may come with a higher tax bill as well. The union budget made two important announcements. One is with respect to contributions made by an employee to their Provident Fund, and the second is with respect to the premium payment to your ULIP, so your unit-linked insurance plans, a very common and popular product that combines life insurance and mutual funds or the equity mutual funds. Let's talk about Provident Fund first. What essentially FM Sitharaman said is that if you contribute more than 2.5 lakh rupees to your Provident Fund, then the interest on that excess amount will be added to your total income and taxed as per your income slab. When it comes to ULIPs, if your premium is more than 2.5 lakh rupees, then on maturity, the capital gains will not be exempt. You will have to pay tax on it. So let's understand the Provident Fund a bit more in detail. If we say 2.5 lakh rupees of annual employee contribution, usually the employee contribution is 12% of your basic salary, because anything beyond that does not come under the purview of Section 80C. You'll have to pay tax on that. So, or rather, it will not be available as a deduction to the employee. So, if we have to take 2.5 lakh rupees to be 12% of a basic salary, it means that individual's basic salary would be at least 20 lakh rupees. So, we are talking about a total CTC, that's basic plus DA plus other allowances, to be close to 40 lakh rupees. So, this is the category of individuals that this provision will affect, because these are the guys that will usually contribute on an annual basis 2.5 lakh rupees. Now, the wonderful thing about Provident Fund is that it comes in the EEE category. It gives you a deduction when you deposit it. There is an exemption for when you are earning interest on it. And there's also an exemption for when you withdraw the Provident Fund at the time of your retirement. So now what the government is essentially doing is it's taking away a bit of that benefit, and it's going to impact only the, like I mentioned, the 40 lakh plus salaried class. So what will be the impact? How will it impact your returns from a Provident Fund? Let's compare this with all the other retirement benefit schemes. Let's say that instead of 2,50,000 per month, you're putting in, you have a salary of 4 lakh rupees per month, which means that your yearly contribution to Provident Fund is 5,76,000 rupees. So the net interest on that will be, and of course then the employer contribution will as well come in. As we know, the Provident Fund return is 8.5%, which is fixed by the government every year. So for now, we'll take 8.5%. Now, there will be a tax on the portion which is above 2.5 lakh rupees. So that comes to, as per the calculation, and by the way, that will be taxed at 34.3%. So if we have to consider that, then the net return will not be 8.5%, but it will come down to just 7.2%. So you understand how the government is essentially penalizing your higher contribution to Provident Fund. If let's say your return, or rather your contribution is 2,60,000, then the net return will be 8.1%. It will not be that severe. So it's better to keep your contribution then in Provident Fund to as low as possible, 2,50,000, 2,60,000, 2,70,000, because then you will have that 8.2 to 8% interest rate. The tax element will not be that high. Nevertheless, if I have to compare this with the other retirement products, it's still better off, because today you have an EPF, like I mentioned, is 8.1%, the bare minimum. That's if you're depositing 2.6 lakh rupees. And NPS gives you 8 to 10%, again tax-free. ELSS is market-linked. Fixed deposit gives you 6 to 8%. PPF gives you just 7.1%, though of course it's absolutely risk-free. So maybe it's a good idea to split it up maybe between an NPS, because that too gives you great returns. Of course, you have to pay tax later on, when you opt for the annuity, but that's only post-retirement. It's many years later. Let's not forget the power of compounding as well that kicks in when you take an NPS. So split up all your retirement benefits. I'll still say that if you are limiting your contribution to Provident Fund to 2,60,000 per year, it's still a better bet compared to the other retirement schemes.